are the two products that you would select if you were to do a illustration. So if we click on FPDA, and I will go and touch on briefly about the products on FPDA. So FPDA are going to be Fit Retirement Series. Those are flexible premium deferred annuities where if the client wants to do a flow, meaning if the client wants to contribute every month, then it's going to be a flow, meaning a premium is going in every single month. So there you would select FPDA. If a client has just one single lump sum, whether it's a rollover or just a single premium that they're going to do, then that is when you would click on SPDA, meaning single premium deferred annuity, and then the options will come up. Okay? So that's a basic information of where you can find the illustrations. And then what you can do is, you know how you submit any applications, EAPs. Now everyone is going to most likely do EAPs rather than paper applications. So with EAP, exactly where you do an IGO EAP to submit a life insurance app is where you would go to submit an annuity app as well. But it's actually caused me error. So let me see if I can go back in. And so exactly in the same place when you do an application, instead of selecting a product type to be a IUL product or a total secure, you would select the product name of the annuity that you will be doing. Okay, so that's quite simple for you. So right now we all know there's a lot of volatility in the market, as I mentioned earlier in the training. And we haven't experienced such an increase in volatility in the market for a very long time. And so right now, I want to emphasize one more time that I did earlier on, is that if you have clients who have an old 401k sitting right now, they're going to be losing a lot of money. So there's so many clients who are panicking. And those clients who are panicking, they just want to get out. They're saying, every day I'm waking up and I'm seeing I'm losing more money every single day because the market is just getting worse and worse. In this situation, we don't recommend that the client does a rollover. But there are clients who aren't going to listen because in their eyes, they don't see that the market is going to get any better. And so in their eyes, they want to get out. For those scenarios, whatever you say as an agent, the client is not going to listen. So for those specific clients, we've had so many agents calling into the sales desk saying, it's my life insurance client. I just did life insurance for them a few months ago, and they're calling me to see if I can help them do a rollover to an IRA. I've never done this before. Can you help me? We've had so many questions like this and so many calls from agents that we thought this session could be a bit helpful to answer some of the concerns, some of the questions that you may have. So we don't promote it. We don't think you should be calling all your clients right now saying, by the way, the market is crashing, as you can see, so let's take all of your old 401ks and let's roll it over to an IRA. We do not recommend that. But for those clients who are insisting that they want to actually roll it over to a safer option, roll it over to an IRA, for those clients, of course you want to help. You don't want to say, no, that's a stupid idea, and then have another agent help them. You want to help them as much as you can. And if those clients are going to sleep better at night, and if those clients are going to be happier if they take it out and roll it over to an IRA, that's where we can help. Someone is saying that the audio is not very good. Are you all able to hear me loud and clear? I'm going to try and see. Okay, so it seems like maybe one person wasn't able to hear very clearly. Hopefully it'll be better now. So in those scenarios where you need to help your client, I'm going to go over some of the products we may have. And so if you have any specific cases or you have any questions, utilize the chat box as much as you can. The great thing about annuities is that you don't need a photo ID verification like you do with life insurance. And another thing is illustration is not required. So you don't have to attach the illustration to the e-app. It's not a necessity. We don't require it. And so another thing you want to know is that for those agents who've never done applications for annuities, it's going to be a lot shorter than what you're used to with life insurance. And it's not 2 sections, it's just 1 section, okay? But remember one other thing, when you're doing the application, you're going to click on iGo eApp, and then you're going to start a new case and then answer all the questions step by step. One other thing you need to remember is that you're going to, if you're doing a rollover, does everyone understand what a rollover means, by the way? So we've had a lot of basic questions, and remember one thing, there's no such thing as a stupid question until you ask over and over again. And so sometimes we get calls who've never done annuities before, and we get calls from agents saying, I need to get an IRA for my client. Can you help me? And so I just want to emphasize, always remember there's different types of retirement vehicles. There's different types of plan qualifications. There is a traditional IRA, a Roth IRA, a 403B for most teachers, 457 for government workers, or even non-qualified. Those are different types of plan qualification. So when an agent calls in and says, I want an IRA, that's just a plan qualification. Another way of thinking of it is it's a retirement vehicle. It's a tax code. Okay? So when you say an IRA, that's just a tax code, a plan qualification. And within the plan qualification, you need to select an annuity product. So when you've selected the correct annuity product for your client, in the annuity application, it's going to ask you, what plan qualification is this? So sometimes you have business owners. They might want to do a SEP IRA, a simple IRA. Remember, that is a tax code. That is a plan qualification. And so you select the annuity product, then you figure out what plan qualification it would be. But simple things you always can remember is old 401ks. If you roll it over to an IRA, so if it's an old 401k, it's a qualified plan. Qualified plan, does everyone know what qualified plan means? Qualified plan means it's pre-tax. So when you roll it over from an old 401k, you would roll it over to a traditional IRA. And remember, that is just the plan qualification. So I've got this PowerPoint that might be a little bit helpful for you to understand some of the simple basics of it. And I will send you this PowerPoint at the end. I literally just came up with it before I just prepared for this webinar, very briefly. So it's literally just giving you some simple explanations. So always remember one thing. For those agents who are familiar with life insurance is going to be non-qualified. Non-qualified meaning after tax money, right? Whereas qualified is going to be pre-tax contribution. So when the client says, I want to do a rollover, that's because an old 401k is going to be pre-tax money that is being building up. And then if they roll that over to us, they will be rolling it over to a traditional IRA, and it will still stay as a qualified plan. So it's going from a qualified to a qualified. So that means it still means the tax is going to be tax deferred growth until you start taking out withdrawals. So in a qualified plan, you do not pay any taxes until withdrawal starts, until you start taking out distributions. Okay? And that is why when agents call up or clients ask, well, can I actually I have a traditional IRA right now. Can I put more money into it from my savings account? There's a limit to how much you can do. With a traditional IRA, there's a contribution limit because every year, if the IRS allowed everyone just to put as much as they wanted into it and let it grow tax deferred, then everyone will be putting as much as they can into it. So that is why the IRS has come back and said, with a traditional IRA, you can contribute up to $6,000 per year as a limit. And if the client is 50 years or older, they can do $7,000 per year. So if the client says, oh, I want to contribute $10,000 this year, well, you can't on a traditional IRA because the maximum is going to be $6,000 per year. And then anything above that, they would have to do a non-qualified or something separately. But any rollovers that you do is already old money. So that would not be included in the new contribution. So if a client has a old 401k from their old employer and they have, say, $300,000 built up, they can roll that over to a traditional IRA, and you would select an annuity product with us, and that would still be allowed. Then any new contributions they put into it this year would be, obviously, there will be limitations. So rollovers, there won't be limitations. The rollover amount, as long as it doesn't exceed $1 million, sometimes we actually do accept more than $1 million as long as you get approval. But with rollovers, it's fine. With new contribution, there's limits. And with a traditional IRA or a Roth IRA, the limit is going to be $6,000 this year, and it will be $7,000 for anyone who is 50 or older. So that's just a brief explanation of how qualified plan works. And you know how I was talking about direct rollovers? Well, direct rollover will basically mean the client has say that they have a 401k, old 401k here, and then they want to roll it over to an annuity product with us, with National Life Group. Then the direct rollover is where the old 401k would transfer whatever is in here directly to us. If you do an indirect rollover, the company would pay a check to the client, and then the client has within the first 60 days to roll it over to us. So that would be called an indirect rollover. So why am I saying this? So every day, right now in America, 10,000 people are retiring every single day until 2030. So that's a lot of amount of people who are retiring every single day. And right now, I know we are in a difficult circumstance where you're having to do a lot of things remotely. You're having to meet clients face-to-face through webinars, through FaceTime, through Skype. And so, yes, Jane, I will be sharing this presentation. So don't worry, this has been all compliant approved, so I will be sending this out to you. So remember that 10,000 people are retiring every day. And so when they're retiring, what do most people want to do? Retirement is a time when you want to do things that you weren't able to do when you were working and building your career. And so when you ask people, what do you want to do when you retire? Some people are going to say that they want to travel the world. Others may say that they want to spend quality time with their family. But those are the times when you really want to do things that you weren't able to do whilst you're working. But the problem nowadays is that people are stressed in America about retirement. And do you know why? Because most people are going to live longer than 20 plus years, 30 plus years in retirement. And so people are scared. Do you know what the biggest financial concern people have is that they will end up running out of money. And so that is a time when you want to help these people prepare for their retirement. So think of it this way. If you have clients right now who need help with their old 401ks, help them. And I can give you different types of products that we can help them and put them in a product which has a 0% floor. So not only do we always emphasize 0 is your hero in our index universal life insurance, but 0 is still your hero when it comes to our indexed annuities. So when the market is doing well, the client will be able to benefit. But when the market is doing bad, the client will be protected with us in any of our index annuities where the floor is going to be 0%. And so the beauty of our flexible premium deferred annuities, we have 4 different types of FIT retirement series. The 4 different types are called FIT Secure Growth, FIT Select Income, FIT Rewards Growth, and FIT Certain Income. And I know so many agents call in saying, why are they all called FIT? Why is it so confusing? I don't know, but an easy way to just remember it, this is how I train myself. Anything which ends in growth, FIT Secure Growth, FIT Rewards Growth, that's going to have no guaranteed lifetime income rider, and that's focusing just on growth. And because it has no GLIR rider, so for those new agents who aren't really familiar with what GLIR is, GLIR stands for Guaranteed Lifetime Income Rider. And Guaranteed Lifetime Income Rider is very similar to Lifetime Income Benefit Rider in IULs. So GLIR is going to guarantee the client an income until they die. But certain products are going to have GLIR on it and the other products won't. So always remember, any products which end in growth won't have the GLIR and will just focus on the cash growth. And because it doesn't have the GLIR, and because it's just focusing on the growth, there's no fees. Yes, you heard me, there's no fees whatsoever. Whereas the product which ends in income, FIT Select Income, FIT Certain Income, those are going to have focus on income, which means it will have the Guaranteed Lifetime Income Rider added on. And that means it will have a fee, it will have a charge of 0.9% every single year. So with the difference between the LIBOR, the Lifetime Income Benefit Rider with IULs, is that you do not get charged the fee until you turn it on. Whereas with annuities, whether you turn it on next year or you turn it on in 10 years' time, you will always have 0.9% fee charged on every single year. So these 2 products which ends in income will have a fee of 0.9% to have the GLIR rider added on. So when would you use one over the other? So this gives you kind of a simple explanation of when you would use one over the other. But I don't always go by this, by the way, because every client is going to be different. Every case is going to be different. So say that the client is focusing on just growth and not on income. Remember, all of these FIT retirement series, these 4 products, you can start as low as $100 a month. That is a minimum of $100 a month. But say in that scenario that you're doing a rollover of an old 401k. When you're doing a rollover, usually there's going to be, an amount that you're going to be moving over. If that amount is $5,000 or more, you can put it into any of our FIT retirement series. And then the client can choose whether they want to contribute more into it. So you can utilize these products as a single premium deferred annuity. Even though it's called a flexible premium deferred annuity, you can still utilize it as an SPDA, as long as the client has a single premium or a rollover or a lump sum of $5,000 or more. Then they can choose whether they want to contribute on a monthly basis, or they can choose not to contribute if they don't want to. But if they are not doing a single premium of $5,000 or more, then they have to do a minimum of $100 monthly contribution. So in those scenarios where you do have those rollovers of old 401ks, these are good products to select from. But then the next question is, which one do I go for? If the client is focusing not on income, but just on growth, it will be between these two products, Fit Secure Growth and Fit Rewards Growth. But then the next question you want to ask your client is, how long do you want to let it grow for? And also, what is your main priority? Because the difference between these two products is Fit Rewards Growth. All of these products, by the way, have a 9-year surrender charge. So after 9 years, no more surrender charge. Fit Rewards Growth sends bonus on any new premiums for the next 8 years, including that rollover you're doing. So a simple way of thinking of it is, if they roll over 10,000 as a rollover, and then they contribute $100 a month, they'll get 5% bonus on that 10,000 rollover, and then 5% bonus on any of the contributions they will do every month for the next 8 years. But with a Fit Secure Growth, there's no bonuses, but it just has a higher cap. So what does that mean? So if you have clients who are super pessimistic about the market right now and they're concerned, they might want more of the guarantees rather than the higher potential and the higher cap. So in that scenario, go with Fit Rewards Growth, which gives you that guarantee of the 5% bonus for the next 8 years. If you have a client who says, I'm looking for that upside potential, let it just grow for the next 20 years, 30 years, then Fit Secure Growth will be the better one to go for. And that's because it has a higher cap. And so if you look at this rate sheet, and I'm going to show you where to find this, because right now, this is the most recent rate sheet we have for annuities, but this changes. And so right now, this is the most recent one, but this can change at any point. So I want to show you exactly where to go online to actually look this up. So right now, I said how Fit Rewards Growth and Fit Secure Growth, they're both growth products, but the two biggest difference is Rewards Growth has a 5% bonus guaranteed, but it has a lower cap. Fit Secure Growth has no bonuses, but has a higher cap. So if you look at this, there's different types of index strategies you can select. The S&P 500, Barclays, or the BAML. BAML standing for Bank of America Merrill Lynch. Right now, these two are the more popular ones because they're both uncapped. And on top of that, these two are the ones which are doing really well. Surprisingly, Bank of America Merrill Lynch has been actually doing really well over Barclays. So sometimes clients select 50% on Barclays, 50% on BAML. But one thing you can remember is just because you chose the allocation right now does not mean it's set in stone. Next year, if they want to change the allocation, they can do that. So always reassure your clients, this can be changed on allocations. So someone is asking, can a client start with a Fit Growth 5 to 6 years and later change to a Fit Income? That's a very good question. But Marco, remember what I said. All of these products of the Fit series are going to have a 9-year surrender period. So if they were to actually, move it over to a different product within that 9 years, there will be a surrender charge. And then Bella is asking, but yes, going off that question you asked, Marco, but that's a very good point, because say, for example, you have a client who is only in their 30s right now, in their early 30s, and the client wants to have income at the age of 65. Well, sometimes I get agents calling and saying, can you do me an illustration on Fit Select Income or Fit Certain Income for a 35-year-old? Then I say to them, right now they're 35. The earliest that they will turn on income is most likely going to be 59 and a half. And the earliest you can ever turn on income is usually 55. So are they going to pay for the next 20 years on a product which has a fee of 0.9% every single year? And I tell the agent, why don't you think about putting them with a product which has growth, no income, which means no fees, no glare, let it grow, and we all know this has a 9-year surrender period. But after that 9 years, say in about year 15, when the client is getting close to wanting to turn on income. Then you can roll it over to another product, whether it's fit certain income, fit select income, or fit guaranteed income. And at that point, you can actually get the client to turn on income after that. Not only would that be beneficial for the client, but you win as well as agents, because you will get 2 commissions and 2 sales out of it. So everyone is happy. So always remember that if you have a young client, not even young, but if you have a client who's in their early 50s, it doesn't mean that people are going to retire at age 60. Some clients may want to retire at the age of 70. So I always ask the question, a 51-year-old male, when does he want to turn on income? And if the client says they're definitely going to be working until age 69, then I say, don't go with an income product, go with a growth product and then roll it over later. Okay? And so with the fit certain income, so between the fit rewards growth and fit secure growth, you can see rewards growth has a 5% immediate bonus, which everyone thinks, wow, you get that guaranteed 5% bonus, so this is a better product. That's not always the case, because when you do an illustration and you let the product grow for the next 20 years, because fit secure growth has a higher cap, just on the S&P 500 you can see secure growth has a cap at 2.65, whereas with rewards growth it has a cap of 1.5. Then we get questions on this part a lot. Agents say, what does it mean by threshold? So remember, what threshold means is it's like a spread. A spread meaning that if the client gets, so say for example, it's 4.95 for fit rewards growth. Anything above the threshold, anything above the spread of 4.95, the client keeps. So if this year they get a rate of return of 10%, the client gets to keep 5.05 and Barclays keeps 4.95. And so you can see the threshold or the spread is a lot lower with fit secure growth, where it's only 2.95. So if the market rate of return was 10%, the client gets to keep 7.05 and Barclays keeps 2.95. So in the long run, fit secure growth could actually do better. So it really depends on your client, because some clients might want that guarantee, especially right now because they're so concerned about the market. Then you have the fit select income and the fit certain income, which is an income product. And the two differences that with the fit certain income, you're going to have the 14% bonus and 12% bonus, 12% bonus with a 5% roll-up rate. Whereas a fit select income is not going to have any immediate bonuses. It actually has a back-end activation bonus. So I might be going into too much detail about these products itself, but I hope you get kind of an idea of how these products work. And so I just want to let you know, you're not going to remember the ins and outs of all of these products right now. But remember, I just want you to get a rough idea on a very high level. And then when you have specific cases, just give us a call at the sales desk and we will be able to help you with the product selection. We'll be able to run that illustration and get that email to you. And so this is just a guidance of how you can help select the right product for the client. And then I'm going to email you with the rate sheets as well. But I said to you, I want to show you exactly where you can actually get the rate sheets. So in the agent portal, you're going to see interest rates. And I'm thinking it might have logged me out, so let's see. So if you click on interest rates, you're going to click on current annuity rates. And annuity rates, and then click on LSW, Life of the Southwest Annuity Interest Rate. And if you click on that, it's going to give you that competitive, the most updated, the most recent rate sheet. So this gets updated all the time. So that's why you want to always double check. You can always call to the sales desk and I'll be more than happy to email it to you. But sometimes on the weekends, or you want to look at the rate sheets in the evening and we're not available, that's how you would go in. just go into the business tools, interest rate, and then current annuity rates. So I'm not ignoring you, by the way. There are some people who are asking some questions. So if I have a client, she is of age 46, Shelley is asking. She doesn't have any retirement plan. What can I start with her? And how much does she have to put in now to retire at age 65? That's a good question. So you just have to be very careful with when you ask the question, how much does she need to put in now? Because we can obviously tell you the more you put in, the more retirement they're going to have. But that's not always going to be helpful for the client. So the way you want to pitch it to your client is, how much are you comfortable right now to contribute? And then when they give you a number, that's where you can actually run some illustrations and give them an idea of how much they will be able to accumulate. And then say, well, this is the number that you've given me, and this is how you're going to end up in the illustration at age 65, at retirement age. And if you want more than that, how about we contribute a little bit more? But that's a good question, Shelley. And so for an age 46 who's not going to be retiring until age 65, I would actually recommend going with the Fit Secure Growth. And when you go with the Fit Secure Growth, it's because it's going to allow you to have the highest cap. So there will be that upside potential that they'll be able to accumulate cash accumulation. So let's run it very quickly. So if we have a 46-year-old client, female, it's going to ask you in the funding and withdrawal section how much to contribute. So you can actually specify. And what you want to do is, if they have any rollovers, any old 401ks, this is where you would input that information. So let's say that they have a 10,000 rollover. And this is a known fact that I want to emphasize to all of you agents, by the way. I know we're running out of time and I'm probably going way over it, but I want to emphasize millennials nowadays are moving from one job to the other constantly. It's recorded that on average, millennials, they will have moved jobs 5 times in the first 10 years out of college. So what does that mean? That means if they're moving from one company to another, they're going to have small, old 401ks sitting around that they don't even know how it's growing. And so for those millennials, you can actually say, let me consolidate all of those old 401ks, consolidate it into one and roll it over to a safe annuity product. So that's another way of pitching to younger clients as well. And so you can actually do an illustration saying the client is comfortable paying $250 a month and they want to only contribute until age 65. This is just an illustration. And so you can specify $100, 100% on Barclays. And when you do a quick view, it's going to give you a very explanation of how much they would have ended up accumulating and what the cash value would be at the age of retirement age of 65. So this is a way of you actually running some numbers with your clients to really educate them and say to them, let's start with something small. You can even start as small as $100 a month, and then we can always up that contribution later down the road. So I know we're kind of out short of time, but we want to do more of these trainings, by the way, to all of you. And so what I want to do is I want you to give us feedbacks. When you have any if you want more training on focusing on running these illustrations, focusing more on our products, let's do more trainings for you, because this is a time more than ever where you're going to all be stuck at home. And this is a time where you can really focus on reaching out to your existing clients who have life insurance, who may need to get some annuities. And so this is a time where you can sit down, focus on your existing clients, and also look at those clients that you reached out to before, that who you never actually did a policy, never wrote a policy for. Those clients might be wanting coverage, might be wanting to look at retirement planning right now. So this is a time where you can really reach out back to them and help them in this current situation. So I'm so sorry, I've gone way over time, but thank you so much for attending, everyone. And tomorrow, we're going to go back into this. And I have a webinar, a presentation I will email to you, even though we literally did only a few pages on it. But remember that I'm here to help you all. We want to do more training so that you can really understand our products. So utilize us at the sales desk. But you all probably have my email addresses. So make sure you email me back, send out feedbacks, any recommendations or any more training you want to focus on, let me know and we'll make it work. Okay? Thank you everyone for attending today. And I look forward to anyone who's going to join me tomorrow. I look forward to doing more training with you. And thank you so much for all the questions. You're awesome, everyone.